Okay, folks, this is Joe Gordon again, our weekly update with Gordon Asset Management. And you can sign up for these updates at wealthqb.com. So we're just going to focus on the present. It seems like the information is fluid and changing every week. Here's a little disclosure information just to attest that we are only giving our opinions. We're not giving investment or tax or any other kind of advice. It's a disclosure we just have to post and not necessarily painfully read it to you. Okay, so there's the update for your friends or any others you know that may want to avail themselves to the call and the slides. It is on replay and the slides as well. So let's look at a market recap. And you can see here that the market was down a little bit last week after being up the previous week. And basically, many of the states are getting back to work. And Jerome Powell was on 60 Minutes on Sunday night, basically saying, they're going to do whatever it takes. So I think that's probably a big takeaway from over the weekend. If you look at sectors, and this is key because, looking at small, mid, large cap is a conventional way of looking at investing, but sectors tell quite a different story. For example, if you look at the quarter to date, you see over here where my mouse is that energy's up 32%, but it was left for dead. It's down 34% year to date. It's not a supply problem, it's a demand problem because everyone shut down in the world and no one drove anywhere. So no gasoline consumption. That has started to pick up a great deal with many of the states reopening. Financials have still had a rough year, up a little bit quarter to date, but down 27% year to date. Same for industrials, down over 21% year to date. If you look at sector by sector and ask yourself, well, what's doing well? Well, quarter to date, technology is up 19 to bring it positive for the year. Consumer discretionary up 22, almost positive for the year. Consumer staples up 6.7 quarter to date, down just south of 7% year to date. And then real estate hit fairly hard just because of the shutdown and a lot of commercial businesses, restaurants, Starbucks, people like that are not paying rent. So anyway, you can see that really it's a sector by sector story, and that there's a lot of vacancies in office space. Like Cheesecake Factory is a good example. 300 stores, they decided and declared they're not paying rent. But anyway, so of the 11 sectors, only healthcare came out ahead last week. So basically, when you look at what investors are doing, they're shunning weak balance sheets. Now, that doesn't mean that's the case in every instance, but if you see here and see Goldman Sachs has strong balance sheet index, and then weak is in pink, blue strong, and you can see that it tells quite a different tale. The strong balance sheet stocks are up 10%, the weak are down 20%. And that goes to show that's going to be the case. The more levered you are, the more people are not willing to take a gamble on your stock. And then you have the tech acronyms, the FAANGs, which is Facebook, Apple, Amazon, Netflix, Google's, or you have the other one adding Microsoft. But if you see here, if you look at equal weighted returns, in other words, not a market cap weighted index, you can see basically that the S&P index on an equal weighted basis is returning less than on a market cap weighted basis. And that's because of these 5 big tech or 6 big tech stocks basically carrying the brunt of the returns. And as we speak still, they represent about 22% of the S&P 500 index, just those 5 to 6 stocks. So in essence, they're driving the bus and they're distorting reality about what the rest of the stocks are doing. So basically, investors are saying, hey, we think those big tech behemoths, they have great balance sheets, very little debt, they're a lot less risky and than all the other stuff. So when you look at PE ratios, they are pretty high. And you can see here the current ratio on the combined S&Ps higher than 20. We had a slide last week, and I think we broke it out a little bit. If you subtract those 5 big tech stocks, from the index. The index is trading more like 16 times, which is right at its historical average of 15.2. So when you look at the overall, when you add those 5 in, you get a valuation of 20 times. So yeah, they can look historically overvalued, but when you peel the onion a little bit, you see really it's big tech that is distorting those averages. But stocks have gotten expensive relative to earnings, and we'll talk about that in a second. So you can see last week the S&P fell below its 20-day moving average the first time since the beginning of April. That usually isn't a relevant statistic in normal times, but here, when the market's moving weekly based off hope and news, it certainly is. So we don't know if the market's going to retest the initial bear market low, but most every time since World War II, when we've had a recession, that has been the case. The number of stocks trading above their 20-day moving average has decreased. And one of the things that a lot of pundits talk about is bull markets are made on breath, where a lot of companies are starting to do well, bear markets when only a narrow few are leaders, which is what we've got. So let's look at coronavirus cases. There's over 1.5 million now, over 20,000 per day. That's a decrease from the highs of nearly 30 a day. We have more cases here in the U.S. than the next countries combined: Spain, Russia, UK, Brazil, Italy, and France. A lot of that is because we're doing more testing, apparently. But you can see the daily new cases has flatlined, and with the economies opening up, and if that's flatlining, that's good news. Similar data here, you can see change in new cases in the past week. Decreasing is in the teal colored states, the tan increasing. Again, North Carolina, for example, is doing more testing, steady in South Carolina, which has opened up, decreasing in Georgia and Florida, which have opened up. Texas, about the same, they've opened up. And North Carolina, as many know on the call, has not really opened up. There's some limited openings as we speak. But some states have higher death rates than others. This is particularly interesting slide in that if you look at who has lower than average recorded deaths, and this is for the week of April 4th to the 11th, so that may be an unusual data point. North Carolina had among the lowest, along with Connecticut, and you can see the other states that had a little higher than average are tan to yellowish in coverage and color. So I don't know that that means all that much because the data is going to change weekly. It's very fluid, and you would expect to have lower than average deaths in states that are not open or not really open or limited openings. So many states, as I just said, are lifting restrictions. You can see in the orange, they've lifted many restrictions or never enacted major restrictions. And then you also see the blue, where there still are big restrictions on business and travel, or there are some restrictions. So essentially, a lot of the country has opened up, especially in the Southeast and the Midwest. And so we'll see what happens. So 22 states still have restrictions on travel and business operations. And there is, as most of us know, there are protests about in every state at the respective governor's mansions to open up. We've had this slide in here before because we think it's one to really be a gauge to look at weekly. The Economic Recovery Index, which measures a lot of things: jobless claims, mortgage apps, high yield bond spreads, etc. Still at its lowest reading in history, but it is ticking up a bit. You can see that down here. We've had it started to see an uptick. So first trend positive the past 2 weeks, but it's still below where it was in 08 and 09 during the financial crisis. And the consumer, as we all know, is spending less. That's a problem. If your economy is basically 70 to 75% services, and as far as GDP is concerned, but it was down a lot, 7.5% month over month, the most since '59. Credit card spending is down. That's why some stocks like MasterCard are down, because a lot of their stock price moves on people spending money and so forth. So you can see that the consumer spending has been blunted a good bit. Retail sales have plummeted. We all know that. If your stores are not open, the only way to buy is online. Online sales are up, but basically big box retailers are taking it on the chin. And you can see here in the second bullet point, retail sales fell by 16.4% in April, which is the most since they started keeping records in the 90s, and also the largest manufacturing decline since records were kept beginning in 1919. Consumer spending's down, but where? And this chart is what you might expect. If you look at the top, you see clothing down 89%, furniture down 66%, electronics and appliances down 65%, sports 49%, restaurants, bars, gas stations, all down the line is down significantly. And you see increases in groceries, so that's why safe stocks have been the Targets, the Walmarts, the Costco's, the Kroger's, which owns Harris Teeter, and so forth. And that's where a lot of smart money has gone because they've actually benefited from the pandemic. Today, for example, Walmart reported breakout revenue growth and earnings for the quarter ending April 30th. And stocks at an all-time high. It was up pre-market about 4%. The key data point in their disclosure was that e-commerce sales were up 100% from the same period a year earlier, instead of growing at 37% at 74%. So that's big news. And we all know that probably the riskiest activity you can do, or at least perceived that you can do, is to go to a grocery store without a mask. So let's look at services and manufacturing. Services business activity index at the top. You can see the gauge just off the chart, low in history. The purchasing managers index, PMI, fell to a record low of 27, just under 27 in April, from 39 or just under 40 in March. And you can see that dip here again. It's not as far as back in financial crisis 08-09, but it's close. And there's the stat. If U.S. GDP is 77% services, then this doesn't bode well for our economy unless things get really going. So one big disconnect here in this slide, as you see, is the blue is charting the S&P 500, and you can see this charted back to the 40s, coming out of World War II, and you can see the blips in here. Here's the financial crisis, and then we're still up here, 2020. But then you see graph the unemployment rate. So we're at record unemployment at just under 15%, over 36 million unemployed since the 1st of March. And yet the stock market is just pushing and advancing as if there's a disconnect. And a lot of people think there is. I think it's a hope rally, but we want to be positive. There's a lot of good ways to play this. So let's talk about retirement accounts. What are folks doing? 50% say they're not going to take money out. They don't plan to take money out, but surprisingly, 30% said yes, and then 20% or just under in a survey said they hadn't taken any out yet, but they plan to in the future. As many people know on the call, there's two ways to take money out if it applies to you, and you have to qualify in your company-sponsored retirement account, 401k or 403b. They have to agree via plan amendment. One is up to $100,000 plan loan, which has to be done by September the 23rd of this year, doubling from the regular statutory rate of $50,000, and you can defer the interest for 1 year and then amortize paid off over the next 5 or for a 6-year term. The other is a penalty-free distribution if you're under 59 and a half of up to $100,000, and in that one you can choose to pay it back ratably, the taxes on it over 3 years, or you can pay it back ratably over 3 years. Depending on what your tax bracket and your situation is, it may make sense, but it's something that we can individually model for those on the call that want to look at it, and your individual facts and circumstances are critical. So one big problem we've talked about previously is the CARES Act. What if it creates more problems in the future than it solves? And you can see here the federal budget deficit will soon be in excess of $25 trillion. The CBO, Congressional Budget Office, forecasts the total debt load is going to approach 101% of GDP, which generally is a warning sign for countries that get way too much indebtedness. Their future growth rates suffer significantly, which means stocks aren't going to do as well. Think Japan since 1989 as a poster child for that. And also, it's interesting that our debt to GDP ratio has never been this high, except dating back to World War II. And I think only in the two world wars did it ever get this high. Tax rates, for those who aren't students of history about world wars, is that the marginal highest rate in the 40s was 90%. So low interest rates allow you to skate by and finance debt at very low costs, but there could be a day of reckoning, and sometimes what will follow is taxes may have to go up on everyone to pay for all this. So essentially, I was front running my other slide here, but essentially this is our big concern, is that you've never seen the government commit to outlays of this magnitude other than at wartime. And with these big deficits at 1.8 trillion increase over the next decade, and with tax rates at the lowest they've been, essentially, except for a brief period in 1986, 7, and 8, we still have the issue of the Tax Cut and Jobs Act, which brought these low marginal rates, generally again of only 12% federal for families making less than 102 or 3,000 of gross wages, and half of that for single filers. But also many of the provisions in that Tax Cut and Jobs Act sunset after 2025. So there could be a natural increase in taxes if nothing's done. And many times that is what happens, and then people get riled up and then Congress tries to do something. But you can see the graph here at the bottom right, tax rates for income and capital gains, 37 being income, ordinary income marginal rate now. You can see back here in the 40s and 50s, it was up in the 90% range. Capital gains also historically fairly low, and so forth. And then up you see the budget deficits as a percentage of GDP with where we are with COVID. There's financial crisis. Here's where we're going versus World War II and World War I. So we've all seen and heard from many, many sources, GDP in Q2 is going to be very bleak, but there's hope for Q3 and Q4. We don't know really, no one knows what's going to happen. It depends on what type of recovery. A lot of people use the term V-shaped, and that's basically it snaps back as fast as it snapped down. We don't really think that's going to be the case because many states are slowly starting up. But anyway, you can see GDP contracted at an annualized rate of 40% in Q2. And the Bureau of Economic Activity advanced estimate went down almost 5% in Q1, and usually it's +3. So GDP is expected to decline adjusted for inflation. And I said it's the fastest shrinkage rate in Q1 since the Great Recession or the financial crisis of 08-09. And so everybody's got projections, but obviously the numbers are going to look ugly short term. Most of the pundits you hear on CNBC or Fox Business are talking about their projections based on 2021 earnings. They've already thrown in the towel that 2020 is toast. Recent health news, Moderna announced positive results yesterday. That's why the market popped. I think the Dow was closed up 800 to 900 points. Small caps rallied about 5 to 6%, which is a good leading indicator that this may be a recovery that has teeth. But you see the various things here. Moderna's positive results. Doctors at Sorrento late last week developed an antibody cocktail to combat the disease. They say it works in every case. I don't know that that's the case, but that's what the headline said. And then you see a bunch of other things going on here. All good news. All companies working at an incredible pace trying to get something out there. And I don't think it's going to be a vaccine ready for a while, but at least an antibody cocktail to ward off the disease. So what will happen? We don't know. Markets will rebound. You can see here a graph we used last week updated that you can see the chart when the various types of viruses that we've had dated back to the avian flu in 05, 06, SARS in 03, swine flu in 09, Ebola, MERS, etc. And then you can just see here that the markets do they correct a little bit and then they snap back. We think that will be the case. We just don't know how it's going to play out and when. But there's always ways to make money and market anytime there's market dislocation. So back here to conclude investment themes, quality companies with deep pockets, great balance sheets is a safe way to play it. I do personally feel we've seen the bottom in energy stocks and financials. If you just watch the consumption of people getting back out on the roads as states open up, gas consumption is going up, which means the demand problem is going away. And West Texas Intermediate topped $30 a barrel yesterday, so it was negative on a close of a month ago. And so, and that was because of storage, lack of storage. So if you think about it, quality, good balance sheets, low leverage, light leverage, and then also cloud based companies, 5G plays, cell tower makers like American Tower, REIT's a favorite, SBA Communications. You know, companies like that, they're going to do well no matter what. And then you think about the grocery stores and the CVS's and the Walgreens and, you know, Costco's. Those are all quality ways to play this as well. We're not so sure about REITs and utilities yet because many states said that utilities could not cut off people's power who didn't pay the bill, which to some people has given them a license not to pay even when they can pay. So we are a little cautious there. But overall, there's companies that are adaptable. Many of you know the term Zoom is now a verb. Zoom me and let's talk. And that basically is a stock that's gone through the roof. And even one that I was surprised to learn about is that with everybody forced to stay at home and work, everybody decided to invest in a nice desk, chair, lamps, lights, fixtures, and so forth. So an online company, Wayfair, actually did extremely well this year. So anyway, there's a lot of ways to play it. We're happy to talk to you individually about it. If you're a client, you know how to reach us. If you are a friend of a client, please reach out. We'll have a discovery conversation. But as I said in conclusion, this is very fluid. It's changing every week. And generally, once we have an 800 to 1,000 point up day, it's followed by a down day. And it's hard to see 2 days in a row of a sustaining rally until we keep seeing cases flatline, new cases flatline, and infections decline, and states open up, and economic activity starts to rise significantly. Well, that's the end for today. So thanks for your time. And as always, we appreciate you taking the time to invest and listen to our thoughts on this. And we'll look forward to talking to you next week. Thank you.